Hello options traders, and welcome once again to another Facebook trading tutorial. And in this video I want to answer what seems to be a very simple question. Can you turn $10,000 into $1 million in just 5 short years? Well, that's the claim that this company is making, and this was forwarded to me by one of the traders in this very Options A to Z group here, and he was just asking for some comments on it. So I thought I would create a video and pass it on to the rest of you. But you can see right here that they are making this claim that you can build this $1 million account in just 5 years. And so what we want to do is to figure out how likely that is to occur. Now, another trader posted a very good answer. If it sounds too good to be true, it probably is. So how does this claim strike you? Does this seem like this is a typical return in the markets? Or is it somewhat on the high side? Is it somewhat exaggerated? And so what we need to do to succeed with options trading is not only say, well, my gut tells me this is not quite right here, but we need to be able to put some numbers on it. And we need to see just how likely or unlikely it actually is. So the first thing we want to do with a question like this is to check out the rate of return that's required to meet this goal. Now it's very easy to do. Let me show you a shortcut formula. All you need to do is take the ending value, or your goal, divided by the beginning value. So in this case, $1 million is the ending value, divided by the beginning value would be $10,000. So that would be an answer of 100. Next, take that number and raise it to 1 divided by the years. That sounds more complicated than it is, but most calculators have a little key that says y to the x, and just hit 100, y to the x, and then take 1 divided by the years, and it will give you the answer. Whatever that answer is, we're going to subtract off the number 1, and then we'll multiply by 100, and that will convert it to a percent. Let's start with a simple example because this will be a little more intuitive. Let's say you started with $10,000 and wanted to end with $12,000 after just 1 year. Well, the formula says to take 12,000, that's our ending value, divide it by our beginning value of 10,000, and our goal is to do this within 1 year. And so I need to raise this number to 1 divided by the number of years, which is 1. So this is just going to be 1. And so we get 12,000 divided by 10,000 is 1.2. The formula then said to subtract off 1, and that equals 0.2. We multiply by 100 to make that a percent, and we see that it is 20%. And that should agree with your intuition. If we have 10,000 and we end up with 12,000, that is in fact a 20% increase. This formula also works in reverse. If you ended up with a loss, you'll see that this number down here, this percentage, will actually turn negative. So the formula works whether we're talking about gains or losses. Well, now let's figure out the return needed to make $1 million in 5 years, starting with 10,000. So we take our $1 million goal here, that's the ending value. We divide it by $10,000 right here. And of course, that's 100. And then we raise that to the 1 divided by number of years. So this would be to the 1/5 power. Of course, 1 divided by 5 is the same as 0.2. I could just punch in raised to the 0.2 in my calculator and it would give me the same answer. So if we do this, take 1 million divided by 10,000 is 100, raise it to the 1/5 power, what do we get? We get about 2.51. Formula says to subtract off 1, that equals 1.51. We multiply by 100, and so we need about 151% per year to meet this goal. And just for some little side notes here, this calculation assumes that we are investing 100% of that money up front. We're putting all $10,000 into the account, and we're expecting to compound it year after year after year at 151% per year. Well, that is incredibly risky, and I can't imagine that any trading group would suggest that that's how it's done. Most of them are going to take pieces. Let's put in $500 here. We'll put in $300 next week, things like that. But to make it simple and to help make my point, let's say that we, instead of putting $10,000 up front, we put in $833 per month for 12 months. That would still be $10,000. What rate of return would we need to meet our annual goal of 151%? Well, if we work through the math here, it's a little more complicated, but it turns out to be about 13.5% per month, or about 163% per year. Notice we've gone up quite a bit from 151 to 163. Also, don't forget about commissions. They add up quickly, and that also is going to make those annualized figures much larger. A couple of other points to take into account. The passage of time will increase that required rate of return. So let's say that you have $10,000 in the account after 6 months' time. Maybe you've had some gains, you've had some losses, but overall you've gone nowhere. You still have your initial $10,000, but now 6 months' time has passed. In other words, you now only have 4.5 years to obtain your goal. What is that going to do for our required rate of return? Well, if we run it through the calculation, it now increases from 151% to 178%. So the passage of time is going to greatly magnify the required rate of returns if you have periods where your account is just sitting flat. Well, what if you do incur losses along the way? Well, those are going to increase that required rate of return even more. Let's say that after 6 months' time, you've lost $500. What rate of return do you need now? Well, we put it into our formula. You now need 181% per year for 5 years to meet that $1 million goal. So part of what I'm trying to show you here is that every single time you incur a loss, no matter how small, or every time that a few weeks or a few months' time passes by and you're not quite keeping up with that goal starts getting harder and harder to reach. That finish line gets pushed back much further. And what happens in these cases, these trading firms realize that, and they are now forced to take even more risk to get you to that goal. They don't want to fail, so they are naturally going to start stepping up and taking more risk to try and keep you on track. And that's really the beginning of the end. That's most likely what's going to burn most people out. But now that we have some benchmarks, looks like 151% is really the bare minimum you're going to need. That's not even counting commissions. That's assuming we're investing everything up front. So let's just work with that. That's our most conservative number, no matter how unrealistic it is. The next step that we want to look at is how likely is it to get 151% per year? Well, first of all, it has never happened a single time in the history of the stock market. And since 1928, the largest gain we've seen was about 52.5%. That happened in 1954. The largest loss was 43.8, or about 44%. That happened in 1931, just after the crash of 29 and going into the Great Depression. Even if we look at 5-year rolling returns, looking at windows of 5-year periods, the market has never exceeded 30% in any 5-year window. So the required rate of return has never been close in 88 years. However, this company is claiming it can be done, and they're guaranteeing that you're going to hit that mark by generating 151% each and every year for 5 years. So this claim becomes a race against time for an event that has never happened in stock market history, and yet they claim that they're going to do it consistently each and every year for 5 straight years. Of course, I know what many of you are thinking. Well, can't I get 151% by using options and gaining leverage? Absolutely you can. However, there's a very big difference when it's being used in this way. Usually what I teach traders are strategies like stock replacement, where we can get good leverage, but we're only using a small percentage of our account to get the returns for the entire account. What this trading firm is doing is saying we have to stay virtually fully invested and get 151% per year. So if we do that, the probability for losses increases dramatically. And here's why. Let's say that you have a $100 call, and here's all of the potential stock prices down here. Here's our 100 strike right here in the center. If that stock price is here at 100 or below at expiration, that is a 100% loss. And as I just showed, that is going to immediately magnify the required rate of return that you need to now meet that goal. No matter how small this loss might be, it might only be $300, $500. That goal is almost virtually out of sight now. So to make a claim like this, what it really comes down to, and this is the key point I wanted to emphasize in this video, it comes down to how likely are you to avoid losses? How good is a trading firm that says I can keep you in the markets and get you this 151% per year, but at the same time, I'm going to make sure that we avoid all losses so that we don't fall into this trap of needing bigger and bigger returns. Well, again, over the past 88 years, 64 years were up and 24 years were down. So that means that 73% of the time the market has had up years, and about 27% of the time it's been down. So what does this tell us? It tells us that if you are to bet on a direction, betting to the upside puts the odds dramatically in your favor. You really have no choice but to go with the trend, right? The trend is your friend. That's what they like to say in the markets, and especially among the technical traders. We want to capture that long-term upward bias. But as I just showed, we have to make real sure that we don't step into a trap and hit a loss along the way. So this becomes the real catch. How likely is this firm to avoid hitting a downturn? Well, to answer that, we can turn to some statistics and say, how likely is it that this firm can predict a downturn, because that's what would be required, given the fact that they have some value-added information? So that's what they're claiming. We know it's not a typical return for the market to get 151%, but they're claiming that they have some magic secret here that they can get this. And in order to do that, they absolutely are going to have to avoid these downturns. So how likely is it for them to do that? Well, let's turn to, it's a fairly complicated calculation. For those who have had statistics will recognize it as Bayes' theorem. It gives us the probability of something occurring given the fact that we have an added piece of information. So I might say, what's the probability that the next toss of a coin is heads, given the fact that the previous three were heads? That's what Bayes' theorem is trying to show us. And what we can do here is say, what is the probability that this firm can predict a downturn given the fact that they have some magical technical indicator? Well, let's take a look. My goal is not to really teach this at this point, so you're going to have to just kind of take this as a blind faith here that what I'm telling you is true, but I'm also going to take some shortcuts. So for those who do know Bayes' theorem, it might not look exactly the way that you learned it in school, because I'm going to look at it in terms of odds ratios, which cuts down the calculations. So let's take a look at the probability that the market is in fact down, or the odds, 24 to 64. 24 times it was down, 64 times it was up. Keep in mind that this is not a probability. These are odds. So if I wanted the probability, I would have to take 24 divided by 24 plus 64, which would give me the 24 divided by 88, or 27%. These are odds ratios. And this term right here with the odds might be what we call a prevalence ratio. This is what exists in the market. This would be your best guess in the absence of any other information, that we're going to have about a 27% chance for a downturn. But now this firm obviously is making a claim that they can give some extra information. That's what they're charging you for. So what do we want to give them for their likelihood ratio? How good are they? 50% would be a really tough number to beat for predicting the market. Do we want to give them 55? What about 60? Anybody want to go 65? Well, why don't we be real generous? We'll give them 70% chance that they can predict these downturns. So the odds of that happening would be 70 over 30. 70 times they would be correct, 30 times they would be wrong. So again, these are in terms of odds. If I want the probability, I would have to take 70 divided by 70 plus 30, or 70%. So we are giving them a 70% chance of being correct, that they can actually predict a downturn, which I can tell you right now is off the charts high. This is overly generous, but just for the calculation, let's just assume this. So to simplify it, if we divide these out, that comes up to 2.33. And I'm going to just multiply 2.33 times 24, and that's going to give me 56 in the numerator here, 64 down below. So the odds of this happening are 56 to 64. What's the probability? Well, to convert that to probabilities, we'd have to say 56 over 56 plus 64, and that equals about 4,667. Let's just call it 47%. The probability that they can call market downturns is not even as good as a coin flip, and that's being generous in saying that they have a 70% chance of being correct. So always remember, whenever you see hyped up ads like this, think about the value of information. Information only has value if it has the ability to alter a decision. So in this case, you can flip a coin and get a 50% chance of being correct, of predicting a downturn, or you can pay $2,000 a year and get less. And I'll leave it up to you to figure out the value of that information. For those who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course at optionsatoz.com.